You're listening to Peter Lewis's Money Talk.
Good morning and welcome to the last day of the week and the final trading day of the quarter. It's Friday the 31st of March. This is Peter Lewis with Money Talk, which is available as a podcast on Substack, iTunes, Google and Spotify. In today's business and finance headlines, Alibaba executives on Thursday further clarified the nature of the restructuring announcements to split into 6 business groups, each with the ability to raise outside funding and go public. In a conference call with investors, CEO Daniel Zhang said Alibaba will be more of the nature of an asset and capital operator than a business operator in relation to the business group companies. CFO Toby said on the call that after the restructuring process takes place, and the separate entities go public, Alibaba will continue to evaluate the strategic importance of these companies, and then it will decide whether or not to retain control of them. China's Premier Li Qiang has warned against allowing chaos and conflicts to erupt in Asia and jeopardise the region's prosperity. Speaking at the annual Bao Forum, he vowed that Beijing will continue to reform and open up. On China's domestic economic outlook, Premier Li said the situation in March would be better than in the first 2 months of the year, and indicators like consumption and investment have become better. Taiwan's President Tsai Ing-wen has arrived in the USA on a 10-day trip, which includes Latin America, to warnings from China of serious confrontation. In response, the US said Beijing shouldn't overreact to Ms. Tsai's trip. And European Commission President Ursula von der Leyen said Thursday that Brussels must develop new defensive tools to counter a more assertive China. She said the EU needed to establish a clear line for trade in highly sensitive technologies such as quantum computing and artificial intelligence, where military use cannot be excluded or where there are human rights implications. On today's programme, I'm joined by Francis Lun, the CEO of Securities. With a view from Australia is Toby Lawson, Director at Statton Advice. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com. US stocks closed higher Thursday despite continued weakness in the banking sector. The S&P 500 added 0.6%, closing at 4,051 and touching its highest level since March the 7th. With one-day trading left for the quarter, the S&P 500 has notched gains of 5.5% for the first 3 months of the year so far. The Dow added 141 points, or 0.4%, to close at 32,859. Tech stocks were the outperformer on the day and also over the quarter so far. The Nasdaq Composite advanced 0.7% and ended the day at 12,013. For the January to March period, the tech-heavy index has gained 14.8%, one of its best quarters in a decade. Financial stocks were the big laggards. The KBW Regional Banking Index fell 2%, taking its losses for the first quarter so far to almost 20%. In Hong Kong, the Hang Seng Index rebounded from morning losses to close the day 117 points, or 0.6% higher, at 20,309. The Tech Index added 0.6%, and on the mainland, the Shanghai Composite rose 0.7% to 3,261. Shares of Alibaba, which surged more than 12% Wednesday following the announcement of its restructuring plans, added another 2.5% on Thursday. And futures markets are pointing to a gain of around 50 points for the Hang Seng at the open. Elsewhere in the markets, US Treasuries made modest gains, with the 10-year yield slipping 1 basis point to 3.55%. The US dollar was sold against most currencies, while oil rose more than 1%. And you can get more details on the latest market movements on my daily blog at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk.
And it's time to welcome our guests. Unfortunately, Andrew Sullivan can't make it this morning, but we do have with us, and delighted to welcome, Francis Lun, the CEO of Securities. Morning, Francis.
Hi, good morning.
Well, let's start with Alibaba. We did get more details yesterday on the nature of this restructuring announcement, which is to split Alibaba into 6 business groups, each is going to have the ability to raise outside funding and go public. It's the most significant reorganization in the Chinese e-commerce giant's history. CEO Daniel Zhang said yesterday that Alibaba is going to be more like a holding company rather than a business operator. But what was interesting was he said the group's going to maintain full ownership of online sales platforms Tmall and Taobao, which are more profitable than the group as a whole, and then it will consider whether or not to stay in strategic control of some of the other business units. So, Francis, what do you make of this? Is this a good idea, do you think?
Well, what you end up is Snow White and the 5 Dwarfs. So, and they deliberately left out the end group, actually. You have 2 businesses under margin that make money. One is, of course, Taobao and Tmall, and the other one is the financial group. Okay?
Which and financial.
Yeah, that's right.
Which they said nothing about.
Yeah, they said nothing about, but those 2 were the ones that make it, that will be significant in the market. But the others, I will not invest in them because they won't become too much. Several years ago, when the share price was at its peak, the Alibaba Group was worth something like 5 to 7 trillion. Alibaba and Tencent were among the 10 biggest companies in the world, rivaling Alphabet, Microsoft, Amazon, etc. And they were on a tear. And then come 2020, when Ant Financial Group was trying to list it, the government put a stop to it. And from then on, it's all the way downhill. And the share price went down to $61. When you split up the company into several small groups, then you lost the size. Because why are these American big techs so formidable? Because of their size, because they're worth $1 trillion or $2 trillion. They can conquer and obliterate all the competitors in their own field. And if you split up Tencent or Alibaba into these smaller groups, they don't have the size. And then their modus operandi before 2019 was really, if you cannot beat them, buy them. So
that's how they grew, didn't they? By all these acquisitions over the years.
That's right. But the Chinese government put an end to it because they passed all this anti-monopoly law and all this, and so what I can say is that the glory days of the big techs in China is over because the government fear the size of these big techs. They discovered that the Alibaba and Tencent, they have more money than the Chinese government, and they have more influence than actually the government because they also control the online media, online platform, and they want to cut them into size. And this Snow White and 5 Dwarf thing is really a response to the government's control. So looking forward, I would rather put my money into the American big techs because they had the size to conquer the world. And the Chinese big techs, I think, will be limited to China. They won't have the size to conquer the world.
So it sounds like you don't really believe that this is going to unlock shareholder value.
I certainly don't believe it because if they can do it, then Apple and Amazon and Microsoft would have split their main businesses into several divisions. The companies that split into several divisions are the companies that are in trouble, like Hewlett-Packard. Hewlett-Packard split into 2 companies because the share prices were not doing well.
So it sounds like the rationale behind this, in terms of the government anyway, it's not unlocking shareholder value. They're not worried about that. It's about control and how they don't really like these big conglomerates, do they? And
that's how the Chinese government look at them. They fear their size. They fear their influence. That's why they have to put a party secretary into the company to control them, so that their influence will not rival that of the government.
So from what you're saying then, this is not going to really reduce what is known as the conglomerate discounts that these big firms have. And we've seen it in the past, haven't we? Because JD.com had subsidiaries that had separate listings, but it didn't really help JD.com that much.
No, it did not. I don't think JD Logistics or JD Health did anything spectacular for the investors. So, well, of course, the market did not agree with me up to now. Alibaba has risen 20% since the announcement. So great for shareholders or investors of Alibaba.
Mm. And what about Ant Group? Nothing was said about it at all, was it? But so where does this fit in, do you think? Do you think the IPO for Ant Group is back on?
I think Ant Group will be listed sometime in the future, but the problem is that they will be put under the same control as the other commercial banks. That means very tight control, and they don't have the freedom as they would have if they had been a technology group. They can do anything, and then they can go like 60 times leverage and all that. But if you operate like a controlled commercial bank or financial institutions, I think the maximum leverage you can go to is something like 10-1. And so they will limit your size and your profitability.
And what do you make of Jack Ma's reappearance in Guangzhou the day before that? I mean, clearly it wasn't a coincidence, wasn't it?
Definitely not.
He didn't just get suddenly fed up with travelling abroad and decided to go home. What's the significance of that?
Well, there were some unofficial reports that the Chinese government wanted Jack Ma to come back. They don't want to see one of the most successful Chinese businessmen to go into exile.
Right.
I don't think that's good. Like Goldman Guai, which went into exile in America and then launched his daily attacks on the Chinese government. They don't want to see that.
And what about the Bao Forum? We had Premier Li there. He's said several times now he's been trying to sort of emphasize his business credentials when he was the head of Shanghai, how business-friendly he was. He's been saying at the Bao Forum all week, China's going to continue to open up. They welcome American investments and American firms coming to the country, and whatever happens, they're going to continue with that process, and that China's going to be very business-friendly, including for private businesses.
Yeah, I think that's a good development. Don't forget the previous premier, Li Keqiang. He is not a Xi Jinping protege. He was not brought up by Xi Jinping. So that is why Xi Jinping never really worked closely with him. And as soon as Li Keqiang took up the premiership and then tried to say something about the economy, and then there is something in the news media said that countering Li Keqiang's policies. It was not until the last year that Li Keqiang was able to say what he wants to say. He's saying that 600 million Chinese were below the poverty line, and we need the hawker economy to help the poor, things like that. And he was honest, saying the real things, but he was not able to launch his own policy. That's why you have these a tax on the big tax, and certainly not very business-friendly policies. But Li Qiang is another story because Li Qiang was brought up by Xi Jinping through the ranks, so that he will be at ease to let Li Qiang to do what he wants to do. So if he's business friendly, that's good. You're not going to find a dissenting voice in the or policy in the Politburo. So I think the economic policies of the new administration will be much more big tech friendly than the previous one.
Do you think US companies, though, are listening? Because according to a survey from AmCham, for the first time in 25 years, a majority of US businesses no longer view the country as a top investment priority.
I think that is a tough job that Li Qiang has to overcome this antagonism. I think the lockdown policies, the COVID policies, certainly did not help. And China has only herself to blame to drive out all these foreign businesses. Apple did not want to expand in India, but with the lockdown and with people escaping from Foxconn factories in Henan, they have no choice. They expanded the capacity of their Indian plant by 4 times, and they moved part of the production to India. But I think China will have to work very hard to win back the confidence of the foreign businesses.
And the problem is that there's also problems on Capitol Hill, isn't there? Because if you're a US company that expands now in China, increases your investments, you're going to get a lot of hostile questioning from lawmakers in Congress. And then also you have things like the disappearance of Bao Fan. That's put people off as well, hasn't it? There's problems all around for US companies.
Yeah, that's right. In Washington, both parties can agree on one thing, that is anything that's anti-China.
It does seem to unite them, doesn't it, as we saw with TikTok.
Yeah, that's right. China bashing is a sure way to win voters. That is why China has such a negative image in America. And, previously, I think the grandson of Deng Xiaoping said something criticizing the government on these policies, but then he was silent, so that now nobody said anything.
What do you make of the economic outlook? We're going to get important data today on industrial production, retail sales, fixed asset investment. Premier Li said the situation in March will be better than in the first 2 months of the year. Are you seeing signs of that?
Yeah, definitely. Well, you just look at Hong Kong. There are Chinese tourists everywhere now, people with suitcases walking around in Hong Kong. So the reopening of China will mean much better, higher domestic consumption, which translate into higher industrial production, the industrial profit for everybody. I think 2023 will be a year of recovery. I think things will get much better from now on. I hope so.
And what do you make then of the markets? If you look at the performance this quarter, Hong Kong stocks really are the underperformers, aren't they? Even compared with the rest of Asia, the Hang Seng up about 2.7% so far this quarter. Compare that with the Nikkei in Japan up 6.5%, the Kospi in South Korea up 9.7%, and if you go over to the US, the Nasdaq up almost 15%. Yeah,
I think we have to thank Alibaba for the late take up. The market take up above 20,000 now. I think we will close. Hopefully, we will close above 20,000, and then actually 20,000 is still a very low point for the Hong Kong Hang Seng Index. It should have been more than 30,000 now if the economy was performing normally. But of course, this past three years have not been very normal. So we are recovering from the lockdown. I think we will continue to recover. Hopefully, we'll go up at least to 26,000 in the year, because mainly due to economic recovery in China.
And what about then for the second quarter? Do you see a brighter outlook for the local markets?
Yeah, definitely. I think with the return of Chinese tourists, and if you go to the convention center, you see many people returning, foreign visitors returning, and hopefully Cathay Pacific can find more flights and hire more pilots and stewards, etc. And I think Hong Kong economic growth will be much better this year, and so will the stock market. I think at least we will go up to 22,700.
Okay, well that's a good sign. It's nice to finish on a on a positive note. Thank you very much for that, Francis.
You're welcome.
Have a great weekend.
You're welcome.
That's Francis Lun, who is the CEO of Securities.
You're listening to Peter Lewis's Money Talk.
I'm joined now by Toby Lawson, who is director at Statton Advice down in Australia. Morning, Toby.
Yeah, good morning, Peter.
Well, let's start off in Australia, because we did have some data, didn't we, on inflation. Came in at 6.8%. I think that was a bit slower than what economists were expecting. Also down from 7.4% in January. What's the feeling now about interest rate rises in Australia? Do you think the Reserve Bank of Australia is ready to start pausing?
Yeah, it's a really interesting debate we're having here after that inflation data. So we saw a 6.8% number from 7.4, as you mentioned, and they were thinking around 7.2, so they were still looking for a 7% inflation figure. So it was quite a good number. Market took that. And, of course, all the commentary after that was what are the Reserve going to do in April. And there was a sense that they were on the verge of pausing on rate rises, and this probably strengthens that argument. I still think it's probably 50-50, although the futures markets are probably pricing now a good chance of a pause by the RBA. But 6.8% is still lofty when it comes to inflation and CPI. So if your target for the Reserve Bank is 2 to 3% over the medium term, they've got a fair way to go. So it's possible that they'll want to get to their terminal rate, their target of let's say, just over 4%. I think we had it at around 4.1, which means a couple of more tightenings in the pipe. So there's a good argument both ways, Pete. I'm not sure, but as I said, I think the market's probably erring on a pause, but I'd say it's closer to 50-50.
Which I presume is also dependent upon what the Fed does, where it's a very similar story, isn't it? If you look at the Fed fund futures markets, it's about 50-50 now, whether or not there's going to be another 25 basis point rate hike in May. And then after that, investors are pricing in 75 basis points of rate cuts, which seems to me to be a bit of a stretch.
You're a little optimistic, I think, on the easings, but the real difficulty is measuring the lag effect, right? So we've had a very hard run up in rates. The data, at least in the employment sense, and even some of the consumer sentiment data, doesn't suggest that it's completely bitten, but I think it's still to flow through. So it's really a timing issue, and I think that the banking crisis that sort of was a bit of an exogenous shock to this whole inflation battle, that sort of forced the Fed to be cautious, but at the same time I think they wanted to make sure that they didn't drop back on their rate hikes, and so I thought it was probably an obvious move that they were going to hike even despite the banking crisis that was occurring, because they didn't want to send the wrong message. And so I suggest it's probably close to 50-50, but if the central bank's determined to kill inflation, then to send a message of pausing may actually have a counter effect, particularly as we think that prices are going to be stickier over the medium term.
And it can all change so quickly, can't it? We've got the core PCE price data tonight from the United States, which is the Fed's preferred measure of inflation. A bad number there, and those odds can completely change on a dime, can't they?
Correct, and that's the whole point. I think we're still in a market that's got a lot of uncertainty. Interestingly, we're watching the volatility index. Is something I watch quite a lot, and it's the VIX is back under 20%, hasn't been like that for a while. And it was up in the high 20s to 30 for a large part of the recent period when this inflation moved. So it seems that the markets are getting a little more comfortable. Now, low volatility doesn't necessarily mean an increase in asset prices, but it certainly helps investors be a bit more confident. And I've just been tracking that for the last week, and it's certainly stabilised below that 20% mark, which suggests the market's a little more comfortable with the banking crisis being out of the way, the Fed may be coming into a pause, and the economy not sliding into an aggressive recession. I think the jury's still out, to be honest, Pete, but that's how the market's feeling right now, I think.
Do you think the banking crisis is over, or the worst of it is over, or do you think there's still a risk that we don't really know, particularly when it comes to small regional banks, not just in the US, but around the world, really, whether it be in Japan or Germany or Switzerland, just what there is on their balance sheets, because it's all a bit of a black hole.
Yeah, well, particularly when you have rules around not having to remark certain assets on the balance sheet if they're held to maturity. So in a sense, it's hard to actually see what the real value is. I think the sectors, in regional banks in the US, some 45, I think, on average, go bust every year in the US. So it's not an unusual phenomenon. I think the non-banking financial sector is one I'd be definitely keeping an eye on, because if you look at it, they can get hit on both legs. They can get hit on delinquencies, going up through economic pain, but also their funding costs go up because they need to obviously borrow from banks and so they can get hit with a double whammy, and the dislocation could occur in that non-bank sector, and that'd be an area where I keep a good close eye on.
And what do you make of the market performance this quarter? One trading day left. If you look at the broad indices in the US, you would think nothing has happened this quarter. The S&P 500 up 5.5%. No sign there of a banking crisis. But then when you look within it, the regional banking index, the KBW index, down about 20%. The Nasdaq 100, which contains all the mega cap tech stocks, up over 20%. Massive divergence.
Yeah, I think the market got a little ahead of itself beginning of the year, right? It got a little bit effusive that the worst was over and got a little excited. And then they got punctured, by the Fed and also by this banking crisis. So, if you look at the overall, it looks like it was a pretty good performance. If you look at it in the prism of what you're seeing now, but at the time, if you look at it a couple of months, January, everyone was getting a little bit excited, weren't they? And the market was quite positive. So I think we've come back. I think there's still some downside potential, and again, not driven by anything exogenous. I think just generally the economic data to feed through, hopefully, for at least the investor side, will reflect the reality of higher interest rates. At the moment, that's still a bit of a conundrum, I think, for central banks and also for investors, is that we should be seeing more aggressive decline in activity, but we're not quite seeing it. So is that going to flow through? Are we going to get a soft landing? Are we going to get a hard recession? And so I would suggest that going into May, and we used to say that equities sell-in may go away, we might yet still see some downside in the equity market before the mid-year.
Equities seem to be correlated with the volatility in the bond markets that we talked about last week, in fact, because there's been some real wild swings, hasn't there? We had something like 12 days in a row where the 2-year yield moved at least 20 basis points a day. I mean, that's just unprecedented. It's the sort of run we haven't seen since 1981. But it seems to have calmed down in the last couple of sessions, the volatility in the bond market, and that seems to have helped stabilise stocks as well, doesn't it?
Yeah, I think the bond market plays a big role in sentiment. The bond market had whipsawed through most of March, settled in towards the end of March. Rates, so we just 4.12, I think, on the 2-year. But well off its highs, right? I think we almost hit a 5 print, didn't we, on the 2-year? That volatility helps. And you can see that reflected in, as you say, equity prices being a little firmer, and also volatility index coming off to sort of more a long-term trend view. So let's see if it remains. As I said, I think we're going into April is an interesting month. You get some holidays. And then, as you know, historically, we've always had that May month, which tends to be a seller for equity. So lots of things to look out for. In terms of dislocation, I think it's really going to be potentially regional banks around the world and then the non-bank sector if there's further rate rises. That may yet be to play out.
I had an email, Toby, from a listener this week who said investors are looking at the corporate bond market for signs of market stress, but he thinks they're looking in the wrong place. He said all the eyes should be on the leveraged loan markets. He says that there, issuance of high-yield bonds is up by about 2 times from last year. There's about 1.4 trillion bonds outstanding. He thinks that's where there could be problems, and that's where people should be looking.
Yeah, I think the high yield sector, definitely. I think investment grade bonds, I think maybe, that should be fairly benign in terms of impact, but obviously the whole bond market gets impact. But yeah, high yield might have got attracted a little bit too much hot money. It's not unusual, right? People chasing bigger returns take greater risk. And of course, on the corporate side, we've yet to see, feel the sense that the corporate sector is in financial stress. It's more the financial sector, maybe the one that's stretched in terms of its ability to continue to provide funding for balance sheets. And I think that's an interesting debate that'll continue to play out.
Toby, thank you very much indeed. Have a great weekend, and we'll talk to you in a couple of weeks. That's Toby Lawson.
All the best.
Thank you. That's Toby Lawson, who is Director of Statton Advice. Thank you very much for listening today and this week. You can get more information on breaking business news and market movements in my daily updates, which are posted on peterlewismoneytalk.substack.com. On Monday's programme, I'll be joined by Alex Wong, Director at Alex KY Wong Asset Management, and Iris Pang, who is Chief Greater China Economist at ING Wholesale Banking. With a view from mainland China is Yanan Wu, who is Chairman of Surfing Group. Have a great weekend, and I'll see you on Monday.
Money Talk